everybody, and welcome to Tax Tuesdays, a fantastic new series that we're doing in partnership with KPMG. Thanks to KPMG for this fantastic collaboration. Thank you to all of you for popping in this morning and being part of the conversation. I trust you all still keeping well, staying safe, especially as the handbrake is now slowly released from our economy. And hopefully, you know, the level 3 regulations have not triggered mass drunkenness across our country. If you are still nursing a hangover from yesterday, I think strong coffee today would be a good idea. But nevertheless, it's good, I think, as a country and as an economy to start getting the wheels turning slowly and to really start moving forward as a country. You know, the coronavirus pandemic is wreaking havoc with global economies. Not unsurprisingly. And I think in response, most national governments have implemented significant economic stimulus packages. South Africa has obviously followed suit and implemented a number of tax relief bills intended to provide a measure of cash flow relief for business. And so those bills predominantly are the Draft Disaster Management Tax Relief Bill and the Draft Disaster Management Tax Relief Administration Bill, both published on the 1st of April, 2020. And so these draft bills contain the proposed legislative amendments required to give effect to the COVID-19 tax relief measures announced by the Minister of Finance on the 29th of March, and particularly with respect to pay-as-you-earn provisional tax and the employment tax incentive or ETI. So I really want to encourage a very interactive session today. We've got 3 fantastic experts who really have earned their stripes in this space and are more than willing to assist anyone that may have some issues or difficulty currently either accessing these relief measures or even just understanding it. You know, it does seem to be a bit of a moving target with continuous updates. And there does seem to be a bit of a lag between sort of the highest level of decision making and actual implementation on the ground. So it's a complex space and fraught with uncertainty and difficulty, but certainly I think the 3 speakers we have today are well primed to guide us through this. So a little bit of housekeeping. You know, as I've mentioned, we really want to make this an interactive session. The chat Q&A functionality very much active. What I would ask, please, is as you ask your questions, if you could just label those questions to make the responses a little bit easier. So, for example, if it's a pay-as-you-earn question or a UIF question or a TERS question, please just label it as such so that we can be sure the right person addresses it. As always, these sessions are recorded, available on YouTube. So please, you know, feel free to share your thoughts and we'd love to engage with you further. Okay, so moving swiftly along to today's session. As I've mentioned, 3 fantastic speakers. First up, we have Melissa Duffy and Carolyn Chambers, who will both be looking at pay-as-you-earn, skills development levy, UIF, and also addressing some of the frequently asked questions around the UIF TERS system. And again, please feel free to wade in at any point during the presentations and pop your questions over into the chat box. So a little bit about Melissa. Mel is a director of the KPMG tax and legal team and has more than 20 years of tax experience. She's been with KPMG for more than 15 years, where she specializes in employment taxes and expatriate taxation. She's also lead partner for the family office and private clients for South Africa and Africa. Melissa and Carolyn will be sharing the initial slot. So Carolyn Chambers is a director also in the tax and legal global mobility services and employment tax advisory team at KPMG. Expertise includes expatriate tax, employee tax, outsourced payrolls and expatriate shadow payroll, international tax and double tax agreements, immigrations, share schemes, exchange control, global mobility consulting, employment contract and global mobility policy design, Africa mobility projects, and retirement reform advisory services. That's quite an impressive CV. Welcome, Mel and Carolyn. Thank you very much for being part of this and for guiding our audience through. And on that note, I'll hand over to you.
Good morning, everybody. My name is Melissa Duffy. I am a director at KPMG. We would like to take this opportunity to thank Accelerate Cape Town for the opportunity to share some insights with all the participants today. I'd like to start with an agenda. I'm going to put my video off just to save bandwidth, and then when we get to the frequently asked questions, I'll put the video back on. So We'll start with an overview of employment taxes in South Africa, and then Natasha will present on ETI. Employment taxes in South Africa broadly encompasses 4 areas: pay-as-you-earn, UIF, skills development levies, and COWIDA, which is sometimes referred to as workmen's compensation. Pay-as-you-earn, SDL, and UIF are due to the South African Revenue Service by no later than the 7th of the month following the month in which such amounts were withheld. That's quite a mouthful. Let me provide an example. Any pay-as-you-earn deducted from an employee in June 2020 is due to SARS by no later than the 7th of July 2020. In relation to May, pay-as-you-earn remittances are due to SARS this Friday, the 5th of June. Where the 7th of the month falls on a Saturday, Sunday, or public holiday, the payment day is the preceding business day. Pay-as-you-earn, UIF, and SDL payments to SARS must be accompanied by a monthly form called an EMP 201. Pay-as-you-earn is a withholding. UIF is a withholding which is matched by an employer contribution. SDL is not a withholding, but a levy payable by the employer only. COWIDA is aimed at providing compensation to employees who are injured on duty during the course of employment. The rates differ from industry to industry. The annual compensation cap is 484,200 for the 12-month period commencing 1 March 2020. The annual return is usually due to the Compensation Commissioner by the 31st of May. However, this year, there's been an extension granted until the 30th of June. Let's move on to the deferral of employees' tax. The employees' tax deferral applies to compliant taxpayers only. The deferral of pay-as-you-earn is applicable to what is called a qualifying taxpayer. A qualifying taxpayer is a taxpayer whose gross income does not exceed 100 million rand, and of this gross income, it must not include more than 20% from passive sources. So it cannot include 20% of rental, dividend, or interest income, except exceptions apply. So what are we saying is the savings for qualifying taxpayers? 35% of the employee's tax liability, which was previously a 20% deferral, may now be deferred in relation to the period 1 April to the end of July 2020. So when does this apply from? Like I said, the 1st of April 2020, with the payroll withholding payable by the 7th of May 2020. When will the payments be due back to SARS? When will the deferred payments be due back to SARS? The pay-as-you-earn must be paid to SARS in equal installments over 6 months in relation to the period commencing 1 August 2020. So you'll have 6 installments. So the 4-month deferral is payable to SARS in 6-month installments from the 7th of September to the 5th of February 2021. What are the practical considerations? So regardless of whether or not an employer wants to use the pay-as-you-earn deferment, the South African Revenue Service, upon receipt of that monthly EMP 201, will automatically apply a 35% deferment. If the employer does not wish to utilize the deferment or does not qualify for the deferment, 100% of the pay-as-you-earn liability must be settled with SARS by no later than the payment deadline in relation to that month. The employee's tax deferred must be paid over 6 months. And when will SARS let you know what the installment, the 6-month payment period is? SARS will issue a statement of account to qualifying taxpayers on or after the 15th of August 2020. Skills Development Levy. We've set out the technical references for the skills development legislation. There are 2 acts. There's the Skills Development Act, which explains what the ambit or the intention of the legislation is, which is to expand the knowledge and competencies of the labor force in South Africa in order to improve productivity and employment. And then we have the actual Contributions Act, which is the Levies Act and number 9 of 1999. So who qualifies for the SDL tax holiday? All employers who are registered for SDL automatically qualify for the SDL payment holiday. Unlike pay as you earn, this is not a deferral. So there's no catch-up payments which are required in the future. Unlike pay as you earn, the SDL waiver does not apply only to compliant taxpayers. In addition, the SDL waiver period is different to that for pay as you earn and ETI. Pay as you earn's deferral period is 1 April to 31 July, and the SDL waiver period is 1 May 2020 to the end of August. So your first month of liability for SDL will be in relation to September 2020, due by the 7th of October. So what happens on your EMP 201? The SDL declaration on the EMP 201 is grayed out, so absolutely no declaration can be made by the employer. Now on to the interesting stuff. UIF, COVID-19 TERS. What does TERS stand for? It stands for the Temporary Employer Relief Scheme and is administered by the Unemployment Insurance Fund. It's applicable to employers who shut down part or all of its operations due to the national disaster. It must impact employees who are suffering a loss of income or who were forced to take their paid leave entitlement. Funds are made available by the UIF to assist contributors upon application, so it is not automatic. It's available for the 3 months commencing April 2020, and benefits are de-linked from normal UIF benefits. So under the normal UIF regime, when somebody goes on maternity leave or is unemployed, the calculation of the benefits is based on credit days. Whereas with the TERS benefits, it's de-linked completely. Benefits are calculated based on what the employee would normally earn by applying a sliding scale replacement rate, ranging from 38% to 60%. So the higher your remuneration, the lower the percentage. The lower your remuneration, the higher the percentage. What is the minimum TERS benefit? It's 3,500 Rand, and the maximum is 6,638 Rand and 40 cents, based on a maximum reference salary of 17,712. So if you have a gross remuneration of 20,000, your UIF benefit will be calculated on 17,712. So who's eligible to apply? Employees must be registered with the UIF and had to be registered by the 15th of March this year, must comply with the application procedure, which is a bit more settled at this point in time. And the closure or partial closure is linked directly to the COVID-19 pandemic. We've covered that. Circumstances relating to a loss of income in relation to COVID-19. Unpaid leave. An employee may be compensated for days of unpaid leave, and then there's the reduction in income, where the employer is not able to pay a full amount due to the employee. The employer may top up the payment in addition to the UIF benefit, as long as the total amount, the sum of the UIF TERS benefit, together with a top-up payment from the employer, does not exceed what the employee would normally receive in a month. This reference in the directive to the concept of remuneration is gross remuneration and not net pay or just salary. Employers are encouraged to pay the benefits in advance and set off the receipts from the UIF. So there's a timing issue. One would apply to the UIF, but sometimes the UIF will only pay the benefits after payroll cutoff or once the payroll for that month has been run. What about leave? Employers may claim for employees who are placed on paid leave. The benefit may be set off against leave pay, provided that the employee is credited with a leave proportionate to the benefit received. We will go through this in the frequently asked questions with an illustration. And the employee, if the employee was paid for full leave, the employer cannot pay the benefit out to the employee, as that would result in the employee receiving more than they would ordinarily. If the benefit is converted to leave and then later encashed, please remember that the encashment of leave is subject to pay as you earn withholding. What are the challenges? These challenges are real. The online portal is sometimes unstable. Foreign nationals initially were automatically declined. Reconciling benefits received from the UIF and determining what amounts needed to be paid to whom and how to credit leave. Payment details are now available to all, and this may cause pressure from employees to pay out benefits which have not been reconciled. And then there's generally a degree of unhappiness amongst employees where some receive a payment and others receive a credit for leave. I would like to welcome Carolyn and ask her to join in the frequently asked questions. I will play the role of the questionnaire, the question, and then I'll ask Carolyn to provide a response. So Carolyn, are UIF benefits subject to income tax or pay as you earn?
Yeah, morning everybody, morning Mel. No, so the TERS payments that are being paid out as part of the COVID application system are not subject to pay as you earn, so they're paid out as a gross amount.
Are the applications for May 2020 open?
Applications for May are now officially open. They opened this week, so they can be submitted if you can get the system to work for you.
Okay. What are some of the online challenges KPMG has helped clients with over the since the 26th of March?
So some of the issues are just related to the stability of the portal. You know, sometimes you just can't get in. Other times it hangs. I guess it's a new system because it is separate to their normal UIF applications. So as a result of that, it's quite, because it's new and it was put together in a very short period of time, it kind of bounces around. When the May claims were supposed to open last week, there was something wrong with one of the cables, and as a result, the whole system had to be shut down again. So it's only recently now been reopened. So yeah, I guess a number of different types of challenges.
Thank you. I'm an employee who had to take unpaid leave during lockdown. Will the UIF pay me my whole salary?
So no, I mean, this is something that has actually made life for a number of employers quite difficult, because employees have been given the sense that they will receive their entire pay from the UIF, that the UIF will cover it. But it's actually only the portion that would be calculated using that sliding scale between the 38 and 60% of the reference salary. The difficulty that a lot of employers are having is that the higher the employee's salary or package, the more limited the percentage of payment that the UIF will make compared to what they normally receive. So higher end income earners are receiving a lot less than what they may have expected. And many of these people have never claimed UIF in their lives, so they have really got no idea what to expect.
Okay. My usual salary is 2,900 Rand. What will my UIF benefit be?
So this is one area where the UIF legislation, or the directive that was issued, has actually allowed for a payment to an employee of more than what they would normally receive. Because there is a minimum of 3,500 Rand payment, and the way the legislation is drafted, the UIF will pay out 3,500 Rand, even though you only earn 2,900 in an ordinary course. So what they've done is they've applied a minimum wage, which is fairly arbitrary because it's applicable to everybody. So there is a situation where those that earn below 3.5 will get more.
Okay. The employer claimed for all employees, but some employees worked during the closure and did not suffer a loss of income. Can the employer retain the excess UIF benefits?
So in these circumstances, the employer is required to pay back to the UIF any amounts that were paid in respect of people who actually worked. Some of the challenges that the UIF is having is that there's an algorithm that's been set up in the background when you submit your application, and sometimes it's not picking up where there were unpaid leave days versus where there was actually work being done. There's an assumption in the system that if you submitted an application for 30 days, the person didn't work for those 30 days.
Right.
So there's a requirement to do a reconciliation and to submit that back to the UIF. The reconciliated information as well as any overpayments need to go back to the UIF account.
Okay, and what about foreign nationals? This has been a moving landscape. First, if you applied, it was declined. Then you had to apply via email. What's the position today?
So as far as foreign nationals are concerned, they are submitted as part of the normal application. So you would submit for the month of May, for example, with all of your employees listed. Your foreign nationals will have passport numbers rather than ID numbers. The system is incapable of recognizing a passport number. So even though legislatively they're included, system-wise they're not. So it will be declined. But there is a set of guidelines that has been released by the UIF on how to then, what is the next step in relation to foreign nationals. So you then need to submit the details relating to those foreign nationals to a specific email address that the UIF has set aside, and those foreign nationals will then be processed manually.
Okay, as an employer, we received a pad from the UIF. Can the employer top up the employee's remuneration? If yes, by how much?
Okay, so absolutely, employers can pay a portion of an employee's remuneration, as long as the total of the amount that the employer pays and the amount that the UIF has paid is not more than they would ordinarily have received. So if they have a standard monthly amount that they receive, it would be compared to last month. If they don't have a standard amount, it would be, you're supposed to do an average of 6 months. The UIF has been accepting an average of 3 months.
Okay, thank you. Employees can now check if the employer was paid by the UIF. Why would my employer not have paid me yet? What are the rules regarding timing of payment to employees?
Okay, so this is now one of the areas that is the biggest contention space that comes with the TERS applications. There are a number of reasons why an employer may not have immediately paid an employee. They are required to distribute the cash to employees within 48 hours of having received it once verified. So the difficulty is, haven't yet verified whether the amounts were correctly received from the UIF or not, or where there are errors or concerns raised with the UIF, those amounts then can't be paid out. The other aspect is there are a number of employees who will have received a benefit listed that may have been incorrectly calculated and may need to go back to the UIF, but it'll still be reflecting on the system as due to that employee. So that's causing quite a lot of conflict and issues between employees and employers.
Okay. All my employees were on annual leave during the initial lockdown period from the 26th of March. I submitted my UIF claim as an employer in early April. I did not receive any UIF payment prior to payday the 25th of April and paid my employees in full. The UIF paid me fortunately on the 28th of April 2020. What do I do in this situation as relates to payroll disclosure and leave credits?
Okay, so in this would be one of the circumstances where the employees would see on the system that there's an amount due to them, and we're seeing a lot of cases where employers are being inundated with queries by employees who are saying, I can see that I'm due UIF and you didn't pay me anything. The reality is, if they were on annual leave and they were paid their normal income, they're not actually entitled to receive anything additional from the UIF. But what must happen is that the employer must credit the leave that is equivalent to the amount of the TERS payment entitlement. And the employer then retains that amount that they've received as the TERS benefit because they've effectively already paid it to employees. There are a couple of payroll disclosures that need to be made. So the actual TERS payment needs to be disclosed in replacement of annual leave pay. And the leave needs to be credited so that they can then at a later date take that leave again effectively. So what the employer is effectively doing through the payroll, using the new payroll codes that were released by SARS, what they're effectively doing is replacing a portion of the employee's income for that month with the equivalent of the TERS amount and crediting their leave back again. So it's not that you have to credit the entire month because the claim would only be for a certain limited amount, as we've discussed. And then you calculate the portion that actual amount relates to your leave credit portion, and the leave is credited in a. So let's say I took 20 days of leave, but my TERS equivalent was only 6 days of that leave, I would get
Yes.
6 leave days back.
Okay. I do have a frequently asked question that's not on the slides. As you know, the TERS legislation is a moving landscape. I think we've had 3 or 4 amendments to the original directive. The latest one, I think, says that contributors or workers who have, or employers who are not part of or haven't contributed to the UIF. So employers who haven't contributed to the UIF may also claim from the UIF. Is that accurate?
Yeah, so what has happened is the latest amendment to the directive, so amendment number 4, directive number 5, has now been released because the UIF were receiving a number of complaints from employees who said, well, how come I can't claim just because my employer didn't register me? So what they've done is they've added some wording that allows for employees to claim themselves where employers have not registered at all, or where employers have not registered a particular employee for whatever reason. And allowing them to then claim, which means that none of those people will ever have contributed to the UIF in relation to the amounts that they're claiming, but they will then be entitled to a claim. We are suspecting that this is going to be an area where the UIF is going to seek to audit going forward. So if I, as an employer, did not register my employees, but I should have, and my employees claim the UIF TERS, I'm going to have on record that I did not comply with the legislation in terms of UIF. So I think employers who were not historically registered for UIF can expect some audit activity coming their way down the line.
Carolyn, this has been a very interesting discussion. Thank you so much for your input. Ryan, we're going to hand back to you and Natasha. Thank you.
Thanks, Mel and Carolyn. Yeah, absolutely right. Incredibly detailed insights. So thank you very much for that. I think our audience will find it really useful. I have a couple of questions that have come through, but I think we can address them towards the end of the session. I think for our next insert, I'd like to just introduce Natasha. So Natasha Rohamalal is an employment tax incentive specialist, and she's going to talk us through the ETI. Natasha has over 10 years of experience working in very diverse areas of tax. She's an associate director in the tax and legal team at KPMG and specializes in global mobility services and employment tax advisory services. I think the ETI is something new for many people. It would be quite interesting to get a deeper understanding of how that operates. So on that note, Natasha, over to you.
Hello everyone, by way of introduction, my name is Natasha and I've been working with the employment tax incentive since its inception in 2013. And I have a lot of technical, industry and practical experience with the employment tax incentive. So just, by way of an agenda, what I'll be covering is what is the employment tax incentive and how does it work normally? And I'll just do a high-level overview for those who have never been claiming the employment tax incentive, but would like to know what is the employment tax incentive and how can it benefit me as an employer. Then I'll cover the COVID-19 proposals, which is, what everyone's very interested in. And then I'll explain some of the challenges that employers and individuals working with the payroll are currently experiencing as a result of the COVID-19 proposals. And then we'll take questions at the end. So what is the employment tax incentive? So employers are incentivized to employ more young workers by way of a cost-sharing arrangement with government. So what this means is the employer can reduce their monthly pay-as-you-earn liability by the amount of the employment tax incentive claim. This is done on a monthly basis by way of the employer's EMP 201 form, and it results in an immediate cash flow benefit for the employer. And, the wage that the employee receives is unaffected. And the employment tax incentive legislation was introduced from 1 October 2013, and it has been extended until February 2029. So how the employment tax incentive normally works, for those of you who have never been claiming and are interested in claiming the incentive, and I'm just going to explain some high-level basics that you would need to know in order to claim the employment tax incentive if you've never claimed it before. There needs to be an eligible employer that pays remuneration to qualifying employees. And all these terms are defined in the Employment Tax Incentive Act. And the employer must also comply with wage regulating measures. And that also is defined in the Employment Tax Incentive Act. So those are the basics. So what is an eligible employer? Okay, you have to be registered for pay as you earn. So as long as you're registered for employees tax, you can make use of the Employment Tax Incentive. It's aimed at private sector employers, so public sector and state-owned entities are excluded. Designated public entities may be allowed in future. And the employer must not be disqualified from receiving the incentive as a result of displacement of an employee. So what does a qualifying employee mean? You'll often see this term in the existing legislation as well as the COVID-19 proposals. In order to claim the employment tax incentive on a monthly basis for every qualifying employee, the qualifying employee must meet these requirements. So they have to be newly employed after 1 October 2013. Can change employers and remain eligible. There's specific legislation that deals with associated employers. So if you're part of a group of companies, it applies to both permanent and part-time employees earning not more than 6,500 Rand per month in remuneration. So it's targeted at low income earners. So if any employees earn more than 6,500, you can't claim the employment tax incentive for that employee. The employee must have a valid ID document, and if they're a refugee or a foreigner, they must have a valid asylum seeker permit and refugee ID, and you must keep these documents on record because SARS often audits the validity of the employees. The employees must be between 18 and 29 years of age. If you're an employer that operates in a special economic zone, there's no age restriction. And it doesn't apply to domestic workers as defined in the Basic Conditions of Employment Act or connected person. So high level, claiming the incentive, how does it work in terms of current legislation? So the employment tax incentive is at its maximum if you pay an employee between 2,000 and 4,499 Rand. You can claim 1,000 Rand per qualifying employee per month if the employee is in the first 12 months of their employment. And if they're in the second 12 months of employment, the incentive is half, so you can claim up to 500 Rand per employee per month. And then the table on slide 27 will show you the bands. So the incentive amount that can be claimed depends on the monthly remuneration, and there's different incentive amounts per the bands. From 1 March 2017, if an employer is employed and paid remuneration for less than 160 hours in a month, a gross up is required. So you've got to gross up the remuneration, then determine the amount of the incentive to be claimed, and thereafter gross down the incentive. So now we'll cover the COVID-19 proposals and what this means. So there's been a number of changes to the legislation. There was a draft bill issued in April, another draft bill issued on the 1st of May, another one issued on the 19th of May, and we probably will see one in the next week or so. So the purpose of the COVID-19 proposals was to expand the relief for employers. Because of COVID-19, employers may see a decrease in their revenue as a result of lockdown and social distancing, employees not being able to go to work. And the relief is temporary, so it only applies from 1 April 2020 to 31 July 2020. And I often get the question, is there a turnover threshold or a gross income threshold? No, there's no turnover or maximum gross income threshold for an employer to be able to claim the employment tax incentive. It applies to compliant taxpayers, which is compliant employers, and the employer must be registered for employees tax with effect from March 2020 in order to claim the employment tax incentive. So some of the latest changes are, for those individuals that qualify under the current ETR regime, the base amount to determine the employment tax incentive claim will be increased by up to 750 Rand. So in the existing legislation, the maximum claim was 1,000, but in terms of new legislation, that can go up to 1,750 per employee per qualifying employee per month. Then there's a relaxation of the age requirement. In terms of the existing legislation, which I just discussed, you can claim the employment tax incentive for employees between 18 and 29 years of age. So it was targeted at the youth. But in terms of the expanded ETI, you can claim the employment tax incentive for employees between 30 and 65 years of age. And the proposal was targeted at retaining the jobs of low-income earners. Then the extension of a claim period. Currently, the employment tax incentive operates for a period of 24 months. It's a 24-month period. But if you have already claimed 24 times, you get another 4 months to claim the employment tax incentive. And you get an amount of up to 750. I'll discuss the tables as we go along. Then a reimbursement can be claimed from SARS at the end of each month where the ETI available to an employer exceeds the employee's tax liability. And SARS are accelerating the payment of the refunds from twice a year to monthly to facilitate availability of cash into the hands of compliant employers. So you're only eligible for an ETI reimbursement if your ETI, your employment tax incentive, is greater than your pay-as-you-earn liability. In that case, you will be eligible for a reimbursement. In terms of existing legislation, it was at the end of every biannual employee reconciliation period, but now it will be monthly. And we have had feedback from clients that they have been receiving the refund within 5 to 10 working days from the South African Revenue Service. It's automatically refunded into the employer's bank account. Okay, and then there have been proposals from 1 May to, with effect from 1 May. And this has to do with the temporary amendment of the definition of monthly remuneration. So in terms of existing legislation, if you employ and pay someone for working less than 160 hours in a month, you have to do a gross up of the remuneration. So the gross up of the remuneration won't be required from 1 May 2020 to 31 July 2020. But I would just like to mention Section 7.5, which is the determination of the employment tax incentive amount, is still in the revised bills, which means that a gross down of the ETI is still required. And that was also explained in the draft explanatory memorandum to the revised bill issued on the 19th of May. There's also been a proposed amendment to the wage regulating measure. So previously, the existing legislation said you have to pay someone the higher of an amount per the National Minimum Wage Act or wage regulating measure. And there was an amount that you could pay of 2,000 Rand, but it only applied in certain instances where an employer was exempt from the National Minimum Wage Act, or where Section 3 of the National Minimum Wage Act didn't apply, or a wage regulating measure didn't apply. But now they've done away with that 2,000 Rand from 1 May to 31 July. So you'd have to pay either the wage regulating measure or the national minimum wage. And this is effective on payrolls, or should be, from 1 May to 31 July. Okay, so this table is how the employment tax incentive has changed. I've updated it for the rates in the revised bill issued on the 19th of May. And as you can see, the employment tax incentive is at its maximum, where employees earn between 2,000 and 4,499 per month. And in the first 12 months, it's 1,750 Rand per qualifying employee per month that the employer can use to set off against their pay-as-you-earn liability. And in the second 12 months, the amount is 1,250 Rand per qualifying employee per month. They've changed the amount. So if you do pay an employee 2,000 Rand or less, and you have to comply with the wage regulating measures, because if you don't comply with the wage regulating measures, you can't claim the employment tax incentive. And that's the first part in a two-part calculation. So first you got to check, do I comply with the wage regulating measures? If yes, you can claim. If no, you can't claim. If yes, and you can claim, then you got to determine the amount that can be claimed. That is the determination of the employment tax incentive. So they've changed the amount, So for the first 12 months, you can claim 87, if you pay someone less than 2,000 Rand, you can claim 87.5% of their monthly remuneration as the incentive amount. And in the second 12 months, it's 62.5% of monthly remuneration. And for employees earning between 4,500 and 6,500, it's an amount determined in accordance with this formula that's on slide 31. So it's not a flat 750 Rand. It may vary depending on the amount produced by the formula. So I often get the question, if I pay my employee 1 Rand, can I claim the employment tax incentive? The answer is no. And that's why they mentioned that in the revised bill. That is not that, because previously in the earlier bills, you could claim up to 750 Rand for people earning less than 2,000 Rand. So it was a percentage of monthly rem plus 750 Rand. But SARS didn't want employers who are paying employees 1 Rand, for example, to claim the employment tax incentive. So they changed that. And there's also the gross down of the incentive that one needs to consider. So this table applies to those, the table on slide 31 applies to qualifying employees who you're currently claiming the incentive for. The next table on slide 32 deals with the relaxation of the age requirements. So where you're claiming for people between 30 and 65 years, and where you're claiming more for an additional 4 times, because you previously claimed 24 times, there's a different table that you need to look at. And I've got the table on slide 32. So the ETI is at its maximum between 2,000 and 4,500. You get 750 Rand. Between 4,500 and 6,500, it's an amount in accordance with the formula. And if you pay someone less than 2,000 Rand, it's a percentage of monthly remuneration. Okay, so what are the challenges? So the revised bill was issued on, on 1 May. Said that the amount of the incentive changed from 500 to 750. And at that time, most of the April payrolls were closed. So if you didn't claim that 250 not claimed in April, you could claim it in the May payroll run and the May payroll. Understand that there may have been some difficulties because payroll softwares were not programmed to look at retrospective adjustments. It only looked at adjustments in that particular month. Most employers did the calculations manually on Excel and then claim the additional amount on the EMP 201 form, which they'll probably be doing this month because the EMP 201 is due on or before the 7th of June, the one for May. So that posed to be a challenge for employers. Parameters set up in payrolls is also another challenge because the legislation the draft bills have been constantly changing. It's changed a number of times, from April through to May. And as a result, the formulas need to be changed by the payroll service providers, and payroll software service providers are getting clarity from SARS, and the updates may not be made in time, or there may be issues with the calculations. So I would recommend that if you have a large population, like a couple hundred employees or more than 50 employees, for example, that you get those calculations reviewed before you claim to prevent an overclaim of the incentive. I have reviewed certain calculations and I have noticed issues with the parameters and the formulas. But if you've got a small population and the risk is small, let's just say 1 employee, then you may let the payroll software, like 1 or 5 where the risk isn't too high, then the payroll software can calculate the ETI to be claimed. But where your population is larger, you may want to reduce the risk, because if you overclaim your employment tax incentive, you underpay your pay as you earn. If you underpay your pay as you earn, you have to pay penalties and interest to SARS, which is not good. The other challenge is the draft legislation or the draft bills. We don't even have a final draft bill yet. It's constantly evolving, and we expect another version of the revised bill to be out soon. So it's challenging for employers to keep up with the changes, to decide whether they should claim or not, how it's going to impact them. also interpretation of the changing legislation. Every time the legislation changes, what does it mean? How does it impact my calculations? And there's that concern of overclaiming. And that's why if you have a large population, you're uncertain, it's a good idea to get your calculations reviewed. I mean, even if you want to prepare them or spot check them, you can get a service provider to just go through them to make sure that they're accurate and you're not overclaiming the incentive. There's frauds and schemes that we see on the market. So there's a lot of arrangements. I mean, while the government is trying to help employers during this time, there may be certain instances where people are trying to take advantage of the system. So where you entering into an arrangement or a service provider approaches you to enter into an arrangement, for example, they could be giving you a number of learners, like 300 to 1,000 learners that they procure and give to you, and you immediately second back to them to do work or training as specified. You know, it's important in these types of scenarios or arrangements to get professional advice, because there are various factors that need to be considered, like general anti-avoidance rules. Are you complying with the wage regulating measures? Are you complying with the monthly remuneration? Because often we see that these schemes are not valid or don't comply 100% with the legislation, or they are general or contravention of general anti-avoidance rules. And if you do claim in these types of scenarios, you could be overclaiming, and then you have to pay back the employment tax incentive with penalties and interest, and potentially penalties of up to 200%. So it's always good when you're entering into an arrangement to seek professional advice. And another one of the challenges we find is tax compliance. So with COVID-19, some of the SARS resources have been strained or have been minimal during the past couple of months. So where you've got any outstanding tax debt or any outstanding tax returns, you can't claim the employment tax incentive. The system won't allow you to claim the incentive. So if, for example, you've got an objection or a VDP or something happening on the system, it won't allow you to claim the employment tax incentive. And I think given you know, availability of SARS resources, the issues may take longer to resolve. So there have been some issues and concerns with regards to that. Yes, so I mean, if you've got any questions, you can always let me know in the chat box. But that's the end of my presentation on the employment tax incentive.
Thanks, Natasha. Great presentation, some really good insights there. I think we've got a little bit of time left. We burned up this hour so quickly. It's quite incredible, but we've got a little bit of time left. And I've seen a couple of questions that have been sent through to me. So the first one is really, I think for Melissa and Carolyn, it's around the UIF benefit. And the question is really just, you know, this temporary measure, how long is it expected to be in place? And the concern being particularly around workers who previously earned less than 3,500 Rand, are we not encouraging unemployment by sort of now allowing them to claim 3,500 Rand? So in effect, they're getting more from the welfare state that we are increasingly becoming than they used to get from employment. And so are we not through that mechanism encouraging unemployment?
I will, there's a double whammy question there. So the first aspect is, I don't think we're encouraging unemployment. I think the system is trying to accommodate and help as many employees and employers as possible. And Karen, would you like to add anything?
Sorry, I was struggling to unmute there for a second. Yeah, look, I think the lower end of the scale, where you have individuals who are going to be receiving more than they would normally get, may cause some confusion for some. But I don't think it's predominantly an issue, because it's effectively allowing for people to be able to survive more during this COVID period. And there's an awareness of the fact that there might only be one person in the family who's employed during this period, where families may have been used to having two. So that may be a bit of a buffer. And the other thing, just in terms of the unemployment situation, is this should allow employers to retain their employees through the COVID period, as opposed to doing large-scale retrenchments. So that's part of the hope with the UIF, that, you know, at least they receive a portion of what they would ordinarily get, and it saves the employers a little in order to survive for longer.
And how long is it expected to be in place?
Go ahead, Mel.
Go ahead. Okay, so the draft legislation, the original directive said it was available for a 3-month period or lesser. So that would definitely be April, May, and June. However, as we had mentioned before, the UIF is running a bit late with the applications. They're running post payroll dates. So I think that employers will have access to TERS well into July in relation to June. So there will be payroll challenges well into July. We'll have to watch watch the space approach to see whether it will be extended or not. I think it will be dependent on the funds available in the UIF.
Yeah.
As we had mentioned, that there's no UIF holiday contributions still being required to be made. So even though they're making payments, they are receiving a trickle of funds in, but it's not equivalent to the amounts that is being disbursed at this point in time. So to short answer, 3 months.
Cool. And that's actually fantastic.
Sorry, Ryan, my worry was if there's so much conflicting information coming through. So, you know, there's so many articles out there, some saying that the UIF has indicated they're concerned because so many employers haven't applied, and then others saying there's a concern that the UIF will run out of money. So, you know, I guess the plan was to go for 3 months. They have extended to non-members now, which makes the pool of claimants bigger. So I guess they will continue to pay until such time as the pressure becomes too much on the UIF.
And that's a fantastic segue into the next question, which is, you know, are these relief measures affordable and sustainable for government? The concern being, obviously, there's been mass job losses, and so the tax base has shrunken quite substantially, and the ability of SARS to generate revenue also has diminished quite significantly. And so, you know, having been downgraded to junk, and with government sort of knocking on a lot of doors for external funding and loans and things like that, which come at enormous cost, you know, how sustainable are these measures, and can we then expect in the near future significant tax hikes, particularly to higher earning individuals and companies?
Yeah, so there is that concern that at some point something's got to give. Yep. You know, we can't have ongoing, continuous funding for all forever. And I think any of these measures in place can only be around for a short period of time. So, you know, the sooner lockdown can be lifted, the better from an economic standpoint. But then we must expect that down the line, there will be an effort to recoup some of the losses, because SARS is going to collect a lot less and hand out a lot more. You know, the UIF is handing out more. Once the reality of where we are from an employment landscape point of view actually hits, you know, in respect of how many retrenchments will there actually be, you know, how many employers will no longer be allowed after all of this is said and done. You know, the concern is that those employees then will be claiming unemployment benefits over and above the TERS claims that may have been submitted, and will the UIF have enough funding to cover that? So, I mean, I guess at some point we can expect to see hikes, whether it's on the wealthy only or across the board or a different type of tax that needs to be introduced. you know, government's going to have to do something. But at this point, we've got to come out of the economic slump first before they can kind of do anything.
Yeah.
If I may add, I do anticipate a very increased amount of audit activity, because that's one way that SARS can collect, and in dispute resolution. So we've already seen in terms of our expatriate taxpayers, an increased volume for request of bank detail verification. So SARS are reluctant or going through a more robust process to validate banking details. Pay-as-you-earn audits and ETI audits will be on the increase. So we encourage employers to be prepared for this activity. So we recommend pay-as-you-earn reviews in-house, or get a service provider, but there will be increased audit activity when SARS gets back on their feet.
Absolutely.
Great point, Mal. Thanks for that. Yeah, I see we actually have run out of time as we tick over to 11 o'clock. You know, I do just want to say, you know, with relation to tax and revenue collection, for me, the concern is really some of the sentiment coming out of the IMF, which we know our government are engaging with. And with South Africa being the most unequal country on the planet, we have the highest Gini coefficient in the world. I think we can, and with the IMF sort of increasingly messaging around inequality and the need to reduce inequality, I think we can probably very well expect some pain for high net worth individuals in the very near future. But you know, as you said, it's a moving landscape. It's changing all the time. Best advice I think that we received today was make sure you speak to professionals and people who know what they're doing in this space. And that certainly includes all three of you. So thank you very much, Mal, Carolyn, Natasha, for your time this morning, for your insights. I think we will share your contacts, of course, with everyone. And I'm sure many people would like to reach out to you and engage you directly, and we certainly would encourage them to do that. But on that note, thank you once again to yourselves and KPMG for this fantastic partnership and for supporting this initiative. Thank you to all our attendees this morning and people who participated in the session. We hope that it was of some value to you and you took some benefit from that. And on that note, nothing left to do but wish you a fantastic day forward. Stay safe, stay sane, if that's even possible under lockdown, and we look forward to engaging you at the next one. Thank you and have a good day.